Tom, welcome to the show.
Thanks, Gus. It's great to be here.
Awesome to have you on. To kick us off with, can you tell me a little bit about what you do at CreditMint and how it's going to change the world?
So CreditMint, our grand vision is that blockchain is here as a piece of equipment to enable the economy to become more bilateral. I mean the financial economy. So today, a lot of company lending, that's where we're focusing on for the moment, is done in a way that is heavily centralized. It's done basically between very large banks and companies. It's very hard for those banks to release the capital from their balance sheets. There's often not a ready market there to get rid of that capital. And we see the economy going away from that very leveraged, very centralized model towards people like you and I lending directly to companies rather than having intermediary banks sitting in between with lots of borrowing and lots of leverage. So CreditMint, we're focusing on one particular asset at first, which is called the syndicated loan. It's a surprisingly enormous economy. It's about $4.1 trillion of issuance every single year around the world. But somehow people don't know it. People know about bonds, they know about equities, but the syndicated loan isn't very well known at all. But actually, it's how a lot of companies of a certain size finance themselves. They take out a loan from a bank or a cluster of banks. The loan might be $100 million or $200 million in size, and it ends up being held by a relatively small number of eventual lenders. And we think that we have the infrastructure through a public blockchain to be able to reduce the threshold for buying and selling that debt.
I want to go into a little bit more depth in the capital markets and also the crypto space as well in a little bit. But before we do that, what's your personal motivation behind starting a business in this area? Why did you decide to leave your previous career in finance to pursue this?
Well, I think the really exciting thing about blockchain, particularly a public blockchain, is it has the capacity to delete a lot of money and a lot of borrowing from the economy. That might sound like a bad thing, but actually a lot of money in the financial economy is just interinstitutional liabilities. It's not really doing anything economically useful or serviceable. It's just Bank A lends to Bank B and Bank B lends back to Bank A. That creates a lot of charges, creates a lot of fees. It also creates a lot of systemic risk in the financial system. But net, it's not that financially useful. So the great thing about a blockchain is it'll allow people like us in the long term to invest directly in companies or lend directly to companies or to other people in the very long term, to do so trustlessly without needing lots of institutions standing between us and them. So in other words, blockchain will be able to delete a lot of gross capital from the economy, so big balance sheets, lots of assets, lots of borrowings, but actually to retain the same amount of net capital in the economy. In other words, the same number of companies, the same amount of equity, the same amount of debt, etc.
When you were working at, I believe it's Park Square.
That's right.
In a debt fund, what were the problems that you kept running into that made you realize that this was something that you could solve possibly through the use of blockchain?
So actually we realized that as well as that grander vision, blockchain had some more immediate benefits to bring to companies like Park Square. So Park Square is as you say, it's a debt fund. They're not very big. They're about 12 billion under management, which sounds enormous, but actually that's not very big in the context of the big economic system. And they were struggling with all kinds of things. They were reconciling their books against their internal systems, reconciling against other banks. And the first thing that struck me was, wouldn't it be great if they and all other lenders could just mutualize their data somewhere, put it all in one place. And really where that data ought to be is the financial asset itself. So if you're able to codify that financial asset so that there was one and precisely only one point of record for that asset, that would do away with this kind of crazy Dickensian system of proprietary databases that the financial economy still runs today. Yes, we're all using PCs, we're all using computers. It looks very up to date. But actually, we still have quill and ink and retaining ledgers that we need to constantly compare to one another. No one quite sure whether theirs is the most up-to-date version of events. So that I realized that as well as the kind of the grander vision of deleting complication from the financial economy, there's also a kind of more micro vision as well of just being able to clear away with all of those processes of reconciliation at the same time.
Were there any doubts going through your head about applying to EF and leaving sort of a safe, cushy job at a debt fund to go and start your own company? What were the things that were holding you back?
There were none at all, actually. So the day I qualified, I left Park Square. I was very happy there. I think they were a great place to do the line of business that I was there to do. But I had read the Ethereum yellow paper. I was not alone in realizing that this had massive implications for reordering the entire financial economy. And I wanted to be a part of that. And I realized that where I probably had a niche was in this, at least at first, in this very localized area of the economy, the corporate lending space, and realized that I would be able to make the implementations that Park Square wouldn't feel, okay, the aliens have landed. What the hell is this blockchain thing? If you're going to migrate a sort of multi-trillion-dollar economy onto a public blockchain, you've got to do it in a way that the incumbents really understand what they're getting out of it, and it doesn't look like some strange foreign piece of technology they can't wrap their heads around. And I felt that put me in a relatively unique position to build that technology. But as far as the EF application came, that was a little bit later down the road. By that point, I'd already met my first co-founder, Zach. And so we eventually joined EF in October last year.
Tell me about how you met Zach.
It was a strange meeting, actually. I think he had come to ask me which accountancy firm he should apply to. My answer was none at all. You don't need to spend very much time with Zach to realize that his talents would be grotesquely wasted in the financial services industry generally. And whilst I didn't necessarily see him straight off the bat, as I didn't realize he's the entrepreneur that he actually is, I was very struck by the depth of his understanding, both actually of economics, which is really surprising, but also his domain of expertise, which is computer science. And he was really able, I think, my second or third meeting with Zach, I realized he was the one because he took me right the way from high-level scripting languages right the way down to the processes that are happening over the chip. He told me a bit actually about when he was really young, he built a 4-bit or 8-bit computer or something. I really don't understand what he was up to, still aged 31. But I realized that his understanding of computer science was very complete and well integrated with his understanding of economics.
And what did the earliest form of that idea that you two were working on look like? Did you have some sort of working prototype, something that was close enough to the final version of what you wanted to build to get an idea of how it could evolve?
Well, yeah, I mean, I know Reid Hoffman's constantly talking about, if you're not embarrassed by your first product, then it's too late. I mean, we were thoroughly embarrassed by our first product. It was barely a product. It was barely a proof of concept, actually. So we had spent a lot of time, Zach had joined me in January 17, and we were really just trying to build the basic smart contract circuits, what was tantamount to a sort of sham front end, but just enough to give people the confidence that this could work, but with none of the sort of enterprise grade development that we knew was going to have to go into this, which is why as soon as we joined EF, our first focus was to try to widen out the team as soon as we could with people who were web development experts.
Tell me about those sort of first hires that you made, or the initial additions to the team of Joe and Arno as well. How did that come about?
Well, so we'd initially avoided the sort of slightly stressful speed dating arrangements on the EF away weekend. And sort of in a rather sort of self-congratulatory way, we're thinking, gosh, aren't we relieved not to have to go through our rather poor dating practices to try to sort of to find a partner, and then actually found ourselves doing just that 3 months later. So 3 months later, we realized both Arno and Joe had broken up with their teams, but we'd also identified that they were amongst the most talented web developers on the program. There was something more to both of them, though, which is they both had a great deal of economic understanding. Joe had been CTO of a Silicon Valley startup, so he really understood how to run a business. Arno's just an incredibly deep thinker on a number of areas, and so there was something more to them than just talented developers. And we identified both of them as people we wanted to try to bring onto the team, and we were very glad to be able to do so. Arno in December and Joe in February.
We can get into the specifics of the capital markets application of what you're doing, but tell me a bit more broadly about the trends that you're seeing in the crypto space at the moment. What's your take on the landscape, and how do you see it developing?
Yeah, I mean, I've been, I think, responsible for upsetting quite a few people with my comments in this area, but I might as well keep hacking away at it once I've got a platform. So I think we're very suspicious of the kind of utility token model that's used to finance a lot of blockchain startups. So that this ICO really arose out of the fact that Bitcoin, Ethereum, they needed this thing, a token, which had in of itself, you might say, no innate value, but was the kind of the requisite piece of value on their platforms to bind all of the nodes on their network into consensus, which is the primary function of a blockchain, is to provide an economic basis for dispassionate consensus. That's the whole point of a blockchain. And then more startups, particularly those startups that had identified as Ethereum as a platform that could be used to buy and sell goods, to create obligations. So they realized it had all these additional purposes, and then couldn't work out how to finance themselves. They wanted to try to do what Vitalik had done, which was just to raise an enormous amount of money on the back of a few promises. But they had no real use for their token. And so the utility token has arisen as a result of the fact that people couldn't work out what the function of the token should be for. So they said, well, it's now just a payment mechanism. It's a widget. It's a thing you buy and sell in order to use our platform. I think the reason this really upsets us is, first of all, the token doesn't represent an asset. It doesn't represent a service. Ethereum and Bitcoin to some extent do. I'll hedge that a little bit, but to some extent they do. They provide consensus. These tokens themselves, if I had one paper sent to me which was about nursing on the blockchain. Clearly, it's illegal to collateralize nurses, right? We outlawed that. Slavery, it's not a thing you're not supposed to do anymore. And so often these services or people's offerings, they can't be collateralized. So that's why the token ended up being merely a payment mechanism. It was, well, we kind of need a token to justify raising all this money. We don't know what to do with it. Therefore, let's make it a payment mechanism. Now, there are a few things that are wrong with this. First of all, you've introduced frictional costs on your protocol that simply do not need to exist. That's the first thing. So if I were using Ether to buy or sell, I'd have much more liquidity in that Ether than I would in the token that's being used to pay for my services. That's the first thing. But second, you've also got FX risk. So if I want to get into an Uber cab and I have to go buy Uber token to do it, there's going to be a time I'm holding that Uber token, and goodness knows what's happening on the Uber money markets outside. I have no idea. It might be worth less or more than when I bought it. And that's a clear economic inefficiency. And the third thing, and this I think is the most the most damning indictment of the utility token, is that you're net short the protocol on which you depend for your survival. So let's put it this way. Here's the base layer. This is the Ethereum network, and you've built a protocol sitting on top of that, right? If Ethereum tomorrow becomes 10 times more efficient, then the net amount of time that anyone buying my protocol token is going to hold that token has just fallen by 90%. It's fallen by kind of order of 10 times. And so that means, all else being equal, subject to other people, to people buying and selling this token to speculate, the value of that token will also fall by 90%. So you managed to buy this thing that, yes, to some extent is long the underlying asset, the underlying protocol that you're building, but is short the thing on which it depends for its survival. That's a crazy situation. It's economically illiterate, and I think the utility token in its most basic form will go away. It'll be a blip in history, but it'll be a very expensive blip in history.
I was going to say, how do you see that playing out? Because obviously the implications could be pretty big given the amount of activity in that space recently.
Exactly. I think all that will go to zero. I think the most worrying thing for blockchain investors generally was that we've spoken actually to John Pfeffer quite a lot about this. He's got some interesting thoughts on this, but people are still trying to work out, where is the value going to go in blockchain? Does it go to the base layer, to the blockchain itself? Does it go to the companies building on the blockchain and building the smart contracts that are going to run our new financial systems? It's really not clear at the moment. Obviously, a lot of the code that is doing the work of those protocols is open source. It's available for public scrutiny. So does that make IP slightly more difficult to defend? I think no one has quite yet worked out how to capture value with blockchain protocols.
How do you stay up to date on developments in the space? Obviously, it's something that you need to do to make progress with the company. And also, give me a sense of where you started off in terms of your knowledge of the crypto space and blockchain technology. and where you've gone to and sort of how you've got there? I'd be interested to know.
Well, I mean, 2 years ago, I didn't know what a hash function was, basically. I mean, I was a pure mathematician by background, so anything ugly that involved numbers was just not going to be something I was going to get involved with. And I think my entry point was the Ethereum yellow paper. It's highly technical. It's almost unreadable. It's basically like sort of machine code. And it took me a long time to realize that there is a new viable form of capital in this space, which is kind of what I call truth capital. But I think it took me a long time to realize that is the one new kind of innovation that blockchain provides. In other words, let's go to a proof of stake model. I take my Ether token, I stake it against what's effectively a node. It's actually called the validator. It's basically a node. If the node behaves well and keeps on approving good transactions that subscribe to the rules of the network, it gets an income. And if it doesn't behave well, if that node behaves badly, then that ETH is going to get slashed, going to be taken away. It's really like a piece of credit or a piece of equity. You're endorsing, in this case, a record of events, whereas with a piece of debt or equity, you're endorsing the kind of behavior of a company. And if that company does well and behaves as you think it will do, then you get some value out of that. And if not, then you lose your value. It's actually really similar. So it observes a lot of those old economic principles. But I think it took me maybe a year and a half to realize that was the real kind of economic innovation of blockchain. And it's why I think, because people haven't done this kind of thinking more widely across the market, most people who are buying and selling these tokens really have no idea why they should be worth anything, nor even what the technologies they think they're investing in are actually designed to do. And they're just kind of hoping their token goes up. I mean, that's bound to end in I think, widespread upset. And the people who have issued those tokens will have done very well out of them. But I think there will be a kind of a cold towel over the head moment in maybe a year or 2 years' time. People realize, oh, that's what blockchain was for. It was really to provide dispassionate consensus. It wasn't about anything else. And that's why we're not doing an ICO at CreditMint. We're doing a traditional equity round in the traditional way, because we do not provide consensus. We're using Vitalik's consensus. As far as keeping up to date on other protocols, we're interested in some. I think Definity is a very exciting product. They seem to have a very quick, what's known as finality mechanism, which allows blocks to be confirmed very quickly, and a way that seems to be very hard for bad actors to game. But actually, when you're looking at a new protocol and something comes across your desk, just you can flick through the white paper in a few moments and know, is there any substance here, or is it just big words and loud noises? That's actually not so difficult to do. And the number of really quality potential future blockchains that we at CreditMint could use for our syndicated loans, it's few and far between. There may be 3 or 4 protocols that we're looking at very seriously. But Ethereum is absolutely top of that stack at the moment. It's got by far the biggest head start.
Talk to me a little bit about the concept of truth capital then. I know it's something that you've spoken about at the crypto panel we had a few weeks ago, and it's something that I think is important to your philosophy of the business and what you're doing. What is it, and what does it mean?
So truth capital is, as I see it, is it's the ability to stake capital. And so I'm really talking about a world in which we move to proof of stake away from proof of work. By the way, that is controversial in itself, and I'll come on to that later. It's hugely controversial, proof of stake. But if it works, it's quite a neat way to allow people to put capital up against simply record keeping, dispassionate record keeping. So I was saying, earlier, in a proof of stake world, you'll send your Ether to a node. It's actually called a validator, but it's like a node. And if it behaves well and attests correctly to the events on the chain, then you'll get a return on that capital. So that's why it's like capital. You've actually got a claim on genuine economics. Those economics are being paid by people who want space on a block. They're people like CreditMint who are going to issue loans, and those loans need to be traded. That's going to cost gas, and that's going to be transaction fees paid across a block. So it's like capital in the sense that if that node misbehaves, for example, if I bought equity in Shell and it turns out Shell actually is a rubbish company and tanks, then I'm going to suffer for that if I back a node that's not behaving correctly. So it's another form of capital. In some ways, it's not different in its basic innovation to equity or debt or whatever. It feels like a fresh asset class, but it observes all of the old rules of capital.
And to put it into context, how do you think we'll be looking back on these conversations 10, 15, 20 years down the line? You were saying just before we started chatting about the way people used to talk about the internet back in the early 90s.
Well, I personally think we'll really struggle to understand this notion of soft consensus which we live in today, which is where, if you take your bank balance is probably the easiest. If you'll forgive me for talking about your bank balance, suppose you've got £1,000 in an account. You are going to. We tend not to be so good at doing reconciliations today, but our parents' generation were very, very careful about checking all the transactions that went through that account and making sure the balance made some sense. The bank does the same at its end. If those two counterparties, i.e. the person who owes the money and the person who owns it, if those were held by the same ledger, you would not need that reconciliation ever again. So I think this whole idea of having companies, banks, holding the records of events for transaction histories in which they have a partial interest. Yeah, because if the bank winds down your account by £500, then that's clearly in the bank's favour. It's clearly not in your favour. But having a decentralised, dispassionate record of events for the sum total of those transactions, so that you and the bank both trust it, but the record of events are held basically by people who don't care. They're just economically incentivised to behave well. I think we'll really struggle to understand why we ever held deposits in a bank. But I think we'll have to tell the next generation, well, look, it was that or the mattress. Those were the only two choices we had. I think dispassionate consensus is going to be something we're really going to struggle to work out how we ever lived without.
Absolutely. And in terms of the benefits of having that, obviously the benefits of the blockchain are the transparency and the verifiability, but a lot of financial transactions need to remain private. The zero knowledge protocol that you've built at CreditMint is something that solves that problem, and I know you're very excited about. Tell me a little bit about it and how it came about.
Yeah, I mean, I take no credit for this at all. It's kind of embarrassing because I'm sort of the mathematician on the team, but I had no hand in building this. It was all Zach, who's our CTO and my co-founder. So we realized January, February, there were going to be all kinds of problems getting our technology to market. The biggest was just go to market. The biggest was turning up to a bank and trying to work out how to tell them, don't worry, the aliens haven't landed. This is all kind of familiar stuff. And we then realized there was one further problem, which is that whilst the Ethereum Foundation has done absolutely amazing work, one thing that they hadn't quite implemented by that point and still haven't implemented was a full, cheap, zero knowledge circuit which would maintain privacy. So as you know, today, the great things about blockchain, immutability, you don't have to worry about who your counterparty is because they will settle because the smart contract will see to that. All these benefits, but everyone can see every transaction that passes across the network. And obviously, it's a huge problem, even for public capital, even for bonds and equity. You don't want people to know that you have £100 in a bond in a certain company or whatever. But particularly for private capital, it's an absolute no-go. You cannot have the world even being able to back out what a given fund or individual is doing with their private capital. So we needed a way for the blockchain to be able to process all these transactions, a public blockchain, to be able to say, right, I've got, let's put this in syndicated loan terms. I've got 10 million of syndicated loan. I want to send you 3 million of syndicated loan. And traditionally we go via a bank and they'd say, well, 10 million is greater than or equal to 3 million. We're going to give you the 3 million. We're going to rubber stamp that. And then we'll allow your balance, my balance that is, to be wound down to 7 million, right? So you needed to serve a bank with all of those numbers for them to be able to ratify that's a good transaction. The zero knowledge circuit says, look, we can codify those numbers, 10 million, 3 million, 7 million. We can encrypt them. But normally when you encrypt something, you lose all the information. It's very hard to then do any tests on that underlying information unless you get the original information back. But a zero knowledge circuit is able to expose just enough to be able to perform all the checks that the bank needs to check without serving the public blockchain with the private information. It's a huge innovation. I'm quite convinced we will be depending on zero knowledge circuits for all kinds of things. Not maintaining privacy is just one of those. But it's a piece of equipment without which we could not have progressed. So Zach went from a standing start in January, February, realizing that this was critical to our survival. This was actually the first event that we had encountered at CreditMint where a failure to solve this problem would basically mean shutting down the company. It would have been that serious. And Zach spent about 6-7 weeks, I think, in all, going from a standing start. He didn't know how elliptic curve addition worked. He didn't know anything about cryptography, really. went from that to building out a full zero-knowledge circuit that would work in a way that was cheap enough on Ethereum mainnet. And we've just had that ratified by our advisor, who's a professor of cryptography at UCL. And we've breathed an enormous sigh of relief, because without this technology, I say no one in the world has yet done this. Without this technology, our transactions could not be kept private.
And what does this mean for the wider Ethereum community? I know you're excited to share it to not just people who are in the space that you're in, specifically in the domain you're in, but also to the wider community. Why do you think it's going to be such a big deal?
So I think the exciting thing about this technology is it at least gets the community going, knowing that they can build out protocols where they want to build on Ethereum mainnet, because let's say they want the immutability Ethereum can bring. They don't want some smaller blockchain. They want the main event. They want the perfect data broadcast that Ethereum can bring, but they also want privacy of transaction. And the trouble for us, as for a lot of protocols out there, they didn't previously have the absolute certainty that zero-knowledge equipment was going to be ready for them, in other words, to make their product viable. So this at least allows products that require privacy to become viable on Ethereum today. There are people like Eli Ben Sassoon and other major cryptographers who are looking at other kinds of zero knowledge and privacy circuits, which are really exciting, but those may be a little way down the line. So this allows people to get going right now with zero knowledge.
You're coming to this podcast there on the back of a grueling few weeks of fundraising and meetings. Tell me how that's been going and the lessons that you've learned along the way, obviously post demo day and negotiating with investors. What have the lessons you've learned been?
I think the thing that surprised me the most is how much VCs talk to one another. I assumed it would be rather like the industry I was in, where everyone keeps very quiet what they're working on. They don't want everyone else to know. And VCs talk to one another all the time. And so you don't realize until you get there how easy it is to end up in this kind of massive aircraft holding pattern. It looks kind of a bit like Heathrow Airport, where the planes are all just in long circles waiting to land, waiting for the next one to land. And you can end up with these kind of circuits of just pure tail chasing. And I hadn't realized that. And we were fortunate that we did have a first investor who broke what I was starting to become concerned might become a deadlock. And once one moves, then everyone moves. And I think that's really surprised me. I would have assumed everyone kept their own deal flow to themselves. But actually, there's so much migration between funds. One analyst is at one fund, and then you call them up 2 months later, and it turns out they've moved to someone else you've also been speaking to. There's a lot of cross-pollination in this industry, and that's been an eye-opener for me.
So to finish up with, I know you mentioned before that there had been some challenges when you realized that you had to build this zero-knowledge protocol. Have there been any other moments where you thought you were going to die, and how did you get over them?
Yeah, I think I was worried at a few industry meetings, potential client meetings, when I was espousing the virtues of blockchain, saying, look, we're going to be able to bring perfect transparency, liquidity, and you just see a tensing of the shoulders, and you realized you've said something that might be a heresy. And often it's a heresy not because actually they don't want it, but they don't want someone else from outside to be enforcing it. And so what I have learned in client meetings is you've got to be a bit more like a shrink and let them talk to you and tell them what problems that they have, rather than going in and telling them what problems you think that you're going to be able to solve, which is surprising to the extent that I thought they would want a technology company to come in and say, here's how the world is going to be tomorrow, and present you something close to a fait accompli. And I think I've learned the lesson not to go in and data dump, but actually ask them a lot of questions about what they're suffering. And often they'll then volunteer. They'll say, actually, we could do with a virtual data room that has the capacity to show management interviews or whatever it might be. And they'll offer you what you were going to present them with in the first place anyway. But I think structuring a meeting that way around, it's been a surprising tactic for me, but it works a lot better than telling them how the world's going to be in 20 years.
Let's end on that note then. Tom, thanks so much for coming on. It was a pleasure chatting.
Likewise, thanks, Nassos.